Hey future millionaires, and welcome to yet another ETF review. Today's ETF review will focus on 4 different iShares ETFs. So get ready to enjoy a deep dive on 4 different iShares ETFs. And at the end of the video, we're going to take a moment to do a simulation of what it would look like if you invested in all 4 ETFs over a 5-year and 10-year span. I think you'll be impressed to see what the balance would end up being. Before you sit back and relax and enjoy the video, please take a moment to like, subscribe, and share, and hit that post notification bell. And if you want to see an ETF review on a different investment group, a different set of funds, please let us know. We'll knock it out as soon as possible. Well, let's get started on this review. In the review, we're going to do a recap of what is an exchange fund and how to buy the funds. And again, for iShares, this time we're going to look at the iShares Core High Dividend ETF, iShares Mid Cap ETF, iShares S&P 500 Small Cap ETF, and a Core Aggressive Allocation ETF. 4 different funds, 4 different approaches, and a whole lot of great results. So again, what is an ETF? An ETF is a basket of investment securities that are traded on the stock market. And so that means, in this case for ETFs, they trade throughout the day, and as such, the share prices changes throughout the day, all course of the day. So the price at 9 a.m. is going to be different from the price at 12 noon. ETFs also have lower expense ratios and fewer brokerage commissions, especially when you buy them directly through a third party that has a good fee structure. Let's jump into a quick recap of how do you buy ETFs. Basically, you want to start with determining what account you're going to buy an ETF in. Because ETFs typically are not in 401ks, we usually look at the opportunity of buying them within either an IRA, an individual retirement account, or a brokerage account. Then you focus on determining which investment broker you're going to work with. These usually the big hitters, Fidelity, Charles Schwab, TIAA, Kraft, etc. And then from there you determine, number 3, the frequency of how you're going to buy your investments, your ETFs within your account. We usually recommend people go with something that's really close to how they are paid, whether it be weekly or bi-weekly. Again, for every person's budget, that's going to be different, but at least monthly. And again, that gives you the opportunity to do dollar cost averaging. To help you in your financial planning, we advise making this automatic transfer. So our average dollar amount per month, automatic transfer, and then two days later, an automatic purchase of those ETFs. For each ETF, we're going to do a quick recap of what the ETF category is, the fund benchmark, fund summary, expense recap, top holdings, and then of course, performance. We use that performance information to help us do that calculation at the end of what it would look like if you bought that ETF consistently for a 5-year and 10-year span. Our first ETF falls into the category of a large value equity, focusing on an index that's composed of relatively high dividend paying U.S. equities. So you're going to be how large companies that are U.S. based that pay dividends. So what is the expense ratio for this one? 0.8. So for every $10,000 you have invested, you would have about $8 of expenses annually. Jumping into the holdings, our top 10s includes companies like Exxon, Chevron, Verizon, Johnson & Johnson, Merck, Philip Morris, PepsiCo, Coca-Cola, and Alteria Group. All of these companies are well known for paying dividends, but you have a good sector spread too. Look at those sectors. Top sectors: energy, consumer staples, healthcare, information technology, utilities, and communications. Those make up 8% or higher. Some great sectors, nice spread diversification, and you have 75 holdings in total that are in this ETF. So you have 75 different companies that are paying dividends. Jumping into the performance, we have a 1-year of 12.3, a 3-year of 9.6, 5-year of 7.38, 10-year of 8.3. And since inception, if you've been with this ETF and holding on to it, you would have averaged 10.2 over the life of this fund. Let's move into our next fund. We have a Core Midcap. This is a Midcap Blend ETF. This one is seeking to track the performance of the S&P 500, composed mostly of mid and small cap equities, diversified with the focus of growth and value style of investing here, people. And what do we get? An expense ratio of 0.5 So what does that mean? That means for every $10,000 invested, $5 of expenses annually. 407 equities, good spread. And what companies do you see in their top 10 holding that only make about 6.7% rounded up? You have companies like Williams-Sonoma, Rensselaer Steel, GoDaddy, and Garco Inc., and then Lennox International. These are some of the more known companies that I mentioned. There's some other ones that are lesser known, but great diversification. Again, what do we have here in our sectors? Look at that sector breakdown. We've got about 22% in industrials, about 16% in financials, consumer discretionary 15%, and IT about 9.2%. And then healthcare, and then real estate roughly around 7%, and materials as well, roughly around 7%. Nice spread among the industries here. And that gives you that great diversification that you're looking for when you have companies, 407 different equities within the ETF. Now let's move into performance. Look at that. Performance, 1 year, big winner, 23%. 3 years, 6.93. 5 year, 11.67. 10 year, 9.3. And since inception, 9.67. Now I want to call out, since inception is 9.6, and then 10 year is 9.3. Look at that. These are some great numbers. And more importantly, we always sit there and say, if inflation is going to be 3-4%, you want to be well past inflation. And look at that. You're getting close to 10% with this one. So you're well past inflation. And it also helps you bridge some of that tax impact also if you have this in a taxable account. Let's get into our third fund. Our third fund is a small cap blend. It's the iShares Core S&P Small Cap Blend. This one is seeking to have all small cap US-based equities. What are the expense ratios? 0.6. So for every 10K, you had $6 of expenses annually for this ETF. And what companies do we have in it? 685 companies. Look at that. That is awesome. Your top 10 barely makes 7%. We'll go through that now. All right. Look at that. So first up, they held somebody in cash, about 2% in cash. Insure Group, then SPS Commerce, ATI Inc., Abercrombie and Fitch, Class A. So remember, a stock can have a Class A and a Class B shares. Apparently, Abercrombie and Fitch has more than one class of collation. Also, Bose and Installed Building Products. Look at that. And what are we looking at for top sectors? Industrials takes the lead in this one. 18.2 in industrials, 17.8 in financials, consumer discretionaries, 14.9, information technology, 12.2, healthcare at 10. 685 different stocks giving you a nice spread. We've got other sectors in there. I'm not going to go over the percentages. We've got real estate, materials, energy, consumer staples, communications, utilities, and then finally, some cash that's held on the side. What do they hold on the cash for? They're waiting for a next opportunity to reinvest into a small company that probably just made it into a small cap sector, and then they'll buy it in cash. Performance, let's take a look. 1 year performance, 15.9. 3 year, a little lower at 2.2. But remember, that's an average. You're accounting for some years that they were really low. 5 year, 9.09. 10 year, 8.76. And then since inception, 9.66. Again, great returns, especially in the 5 and 10 year since inception. And those are going to help us when we put together that portfolio at the very end of this. Number 4 fund, iShares Core Aggressive Allocation ETF, going by the ticker of AOA, category Global Allocation. So you're going to see a nice spread. Like all of our funds, it is seeking to have growth. This one is going on underlying equities that have fixed income funds intended to represent the aggressive target sector allocation. So if you're looking at this one and you wanted something aggressive, this one might be a good one for you. What do we have for expensive? 0.15, and that's likely because you have a lot of international there. So again, we have 10 for every 10,000 you have invested, you would have about $15 of expenses per year. With this ETF, you get 7 holdings in totals. But take a look at those holdings. They are all ETFs. So this is an ETF that holds all ETFs within it. And then from there, in those ETFs, let's just give a quick rundown. You've got an S&P 500 ETF, a miscellaneous international ETF, total core bond holdings, so it's a bond ETF, miscellaneous emerging market, a little bit of mid cap, a little bit of aggressive bond aggregated bond ETF, and then a small cap. But let's look at those holdings. So if you aggregate all those ETFs and you take those holdings and look at them from a corporate perspective, 15% or close to 15% are made up of some big name customers that you know of. You have companies like Microsoft, Apple, Nvidia, Amazon, Meta Class A, Alphabet, that's Google's parent company, Alphabet Class A, Berkshire Hathaway Class B, that's the cheaper of the two, Berkshire Hathaway, Alphabet Class C, and then some cash, and then Eli Lilly. So a great diversified play here. Now let's take a look at that performance. Performance, 1 year, killing it, 18.29, 3 year, 5.28, 5 year, 8.82, 10 year, 7.54. And since inception, if you bought this and you've been holding on strong, you had 9.49. As a reminder, we like to put these ETFs in action. We're going to take a look at what your balance would be if you invested consistently in these four ETFs for a 5-year period of time and then a 10-year period of time. I think you're going to be surprised with the high quality results you'll have with these ETFs. All right, now let's jump into the numbers. We're going to take it to the spreadsheet and take a look at all four ETFs. So today we're going to have someone who's on a hypothetical making $70K, and they've decided that they're going to save about $10,000 per year in a non-retirement investment account. Right, and then from there, let's look at it again. So one more time, let's do a quick recap. First, iShares High Dividend ETF. Your 1 year was a 12, 3 years 9.06, 5 years 7.38, 10 year 8.31. Then we have the mid cap, our mid cap blend, I believe. This one had a 1 year of 23.3, 5 year of 11.67, and a 10 year of 9.93. From there, we had a small cap. This small cap had a phenomenal first year, 1 year of 15.91, 5 year of 9.09, and then 8.76 is what it had for 10 years. Finally, I like this one. This is our aggressive growth one, aggressive allocation one, and this one's called AOA. So AOA has returns of 1 year of 18.29, 5 year of 8.82, and then finally a 10 year of 7.54. All right, you invested in this fund consistently for 5 years. Your balance would have ended up being, for 5 years, $65,749. Let's walk that out. So the invested dollars would have been $50K or $5,000 per year, $10,000 per year for 5 years. Then you would have had invested growth of $15,700. That would have been about 24%. So $15,700, 24% growth in your balance. Your balance would be composed of 24% growth in a 5-year span. Now let's take a look at the 10-year. Boom, 10-year. Whoa, look at that. You would have had $162,000 in your balance. Let's walk that out one more time. Your balance would have been invested dollars of about $100,000, so $10,000 every year, consistently getting your dollar cost averaging in, and then your growth would have been $62,000. That would have made up about 38% of your balance. And that, again, is $62,000 of growth in 10 years span. I know it seems like a long time, but life flies, and if you invest consistently, you buying in the highs and lows, so dollar cost averaging, you could make some major money. You could have some major money invested. Do this type of thing on top of a 401k, which is why when we do this and when we work with customers directly, we like to walk them through on a hypothetical cases of what their 401k would look like, and then possibly an IRA, and then possibly even invested dollars. And many times when you add that all up over 5, 10 year, more likely 10 year, even 15, 20 years, we've got some other spreadsheets that do that. You could find that a person can become a millionaire. But they have to invest consistently. They have to have the discipline. And that's what we help a lot of people end up figuring out, their path to millionaire status. Now, again, past performance does not indicate future results, but it does give you a picture of the art of the possible. And these things are at your fingertips, available to everyday people. And if not, you could get some investing advice from a financial professional, a financial advisor. They could help you, especially outside of your 401k and your IRA balances, as well as an investment account balance. Hope you enjoyed the video. So many more reviews to come. See you in the next video. Hey, thanks for staying to the end. This video is brought to you by the Next Chapter team. If you enjoyed the video, please drop a comment. Please also like, subscribe, and share for your friends and family. This will help the channel reach out to more people just like you. We offer one-on-one coaching where we work with everyday people to determine a clear path to achieving their financial goals. This includes things like budgeting to reduce debts, planning for big purchases, and even learning how to build wealth with the tools that you have readily available to you. If you're interested, please see our link below to schedule a free call with our team. That's right, it's a free 30-minute call with the team. Also, check out our affiliate links for high yield savings account. This is a great place for the saving up for those big purchases and your emergency fund. Thanks, and see you in the next video.